Economic growth, apparently, it's looking better than expected. This is according to the OECD, that's the Organization for Economic Cooperation and Development. New projections show the global economy will grow by 3.2% this year, which is up slightly from the 2.9% projection back in June. Joining us now is economics editor for the Wall Street Journal, Paul Hannon. Joining us from London. Paul, great to see you this morning. Help us understand what this global upward revision indicates for the U.S. economy.
Good morning, Errol. It indicates that the U.S. economy isn't going to slow as sharply as the OECD thought it was going to slow earlier in the year. It's trying to figure out what kind of impact these tariffs will have, and it's slightly overestimated for this year. But it is not saying that these tariffs are not going to hit home. It's just saying that some of the pain will be delayed until 2026.
And you mentioned some of the U.S. tariffs, which is a component of this report that didn't have all good news. Explain more some of the warning signs for the global economy and the U.S. economy in this report.
Well, what they're seeing is that, business surveys are showing a fall in activity. We've already seen data from the jobs market in the U.S. that's showing weakness. There's a pickup in prices across a sort of wide range of imported goods. So, they see these warning signs, but what they're saying is that, as of now, things have been eased a little bit because earlier in the year we had a lot of stock building. Some companies have been able to switch to equivalent imports from lower tariffed countries, but that's not going to be sustainable. At some point, the actual tariffs, which are at 18.5% on average, and that's the highest level since 1933, these tariffs are going to hit home. They are going to be felt by consumers going to the stores.
And so, Paul, did economists give any suggestions on what could fix the worsening situation?
They suggest that the US government and other governments sit around a table and try and negotiate these things down by coming up with solutions to the problems that the president has identified. I don't know how realistic that is. It's maybe a hope more than an expectation. The other thing they say can be done is that the Federal Reserve can cut the key interest rate by, maybe another 75 basis points, not quite a full percentage point, but close. That should help, support the jobs market, support the economy. But nevertheless, they think that next year the US economy will grow by 1.5%. And to put that in perspective, there have only been 3 years this century that have been weaker. And we're talking there about the pandemic year and then the 2 years of the financial crisis.
Interesting. Sobering stuff. Paul, thanks for breaking it down for us. We appreciate it.